All right, we are on the last video of our loan series. Policy loans, how they work. I hope you enjoyed the series thus far. We're going to go through probably one of my favorite topics here. We're going to, of course, pull up some spreadsheets because I can't resist to look at those. So when it comes to payments, this is the topic we want to look at. And this is, in my opinion, a huge attraction point of life insurance loans. Because when it comes to payments, the policyholder is in control. So to begin, when it comes to repaying policy loans, you're in control. The policyholder has ultimate control at the end of the day. This is a huge advantage. When you look at the idea of the banking concept or banking yourself, the control, that's everything. It's discipline. It's the individual that really makes everything work, the individual policyholder. But the key difference here is with a life insurance policy, you control how and when you make repayments. If I have a loan through a lender, am I in control? Not really. I take that loan and I pay it back based on their terms. So as we continue here, payments themselves are not required. To touch on and elaborate on that point a little bit, cash value life insurance for such a long time has really been sold and used as a retirement supplement, tax-free retirement. Take an income stream from a policy on a tax-free basis. How that is done is many will utilize cash value life insurance. They'll overfund a policy and then begin to take income from it. They'll often withdraw up to the cost basis and then begin to loan out the rest without paying that loan back. They're supplementing their income on a tax-free basis. It's a powerful tool. We want to be aware of what the drawbacks are in that particular situation, but how they're pulling income out tax-free beyond their cost basis, what they paid in, is because they're not required to pay loans. So it's a good piece of information to be aware of. If I elect to pay it back, which we'll always recommend if I'm loaning from the policy and I'm actively using it, it does often make sense to pay it back, is I'm in control. So I can set up regimented payments, I can set up an automatic payback schedule, or I can just pay it back at leisure. I can throw money at the principal balance, like a line of credit, with a bit more control in my court as the policyholder. Unpaid interest. So if I do not pay the loan interest, what happens? Common question, and it's a good question to ask, is if I don't pay the loan interest, it does have to be satisfied. The policy will borrow from the cash value, it'll borrow from itself to satisfy that loan interest. That will also collateralize the death benefit. Remember in the overview video, when we pull a loan from the policy, our death benefit is collateralized. The same thing happens if a policy has to loan from itself. It's going to borrow from the cash value to satisfy the loan interest. Your death benefit will be collateralized. Remember, you're still earning dividends and everything, which does help offset some of that loan cost as well. So that's often how it continues to sustain itself. Now, options. Paying it back. This is something we're going to close with this, but anytime we look at a loan, I am a big believer in seeing all the options as opposed to just seeing kind of like our overview video we showed in or non-direct and direct recognition, what it looks like when you borrow and repay. If we're looking at a personal scenario, situation, I do like to see the situation, hey, what if life happens and I can't pay it back? How is that going to impact my situation? Well, we can look at paying it back, paying interest only, making no payments ever. I like to see that kind of stuff. And then this question is very good to ask is, hey, if a policy lapses with a loan on it, right? Let's say I take out the maximum loan and pay nothing back. It's going to lapse if I do that. If I loan out every penny, the next year I don't cover the loan interest or anything like that, it'll lapse. What happens if a policy lapses with a loan on it? We have a potential tax issue, which if I have pulled out more money than what I've paid in, I've exceeded my cost basis, even if it was through loans, once that policy lapses, I am potentially going to be liable to have to pay income tax on the gains. Now, I'm not a CPA or a tax attorney, so I'd always consult with a CPA or tax attorney. We're not giving tax advice at all. However, it's good to be aware of what could potentially happen with the policy, cost basis, all that good stuff. Let's look at some options. So, anytime we look at a policy, these are non-direct recognition examples here. No, I'm sorry, these are actually direct recognition examples. We wanted to mix this one up. But what I wanted to see first is, hey, what's my policy look like? Always compared to growth, so I can see the actual impact. When I pay $50K, let it sit and grow. And then the exact same policy. This will look familiar if you saw the direct recognition example. There's my $200K loan. Cash value dips. Death benefits collateralized. And we're going to assume 0 out-of-pocket loan interest payments. Loan balance compounds. Dividends increase too. So this is the direct recognition. And again, that's because this company raises the dividend rate on borrowed funds. Time passes. This is the kind of stuff I want to see up front. What's the long-term impact? Right, so we deliberately did this. Look at this. So cash value held, but eventually started coming back down. And it starts to go back up, but the reason why is in blue is your annual outlay, annual out-of-pocket. The illustration, the software, will properly warn an agent in a case like this. You want to look at the dividend rate, guaranteed rate, everything here, is if it calls for more money, what it's telling us is either A, at age 82, the policyholder will have to pay in more money, or the policy will lapse. I can run into an issue here, which we don't want. If my plan was to pay in for 5 years and that's it, and I'm told almost 50 years later I'm going to have to pay money in now, not good. So we want to forecast this stuff up front. We always cover this very thoroughly in how to properly forecast this in our agent training calls. So if you're in the business and you'd like info on that, let us know. But that's the kind of stuff I want to see up front to avoid a potential lapse and a potential big tax bill, which I don't want. By the way, if the loan interest compounds on itself, whatever that loan balance is going to be counted against my cost basis. You can get in trouble when you hear these stories about life insurance causing big tax bills because policies lapsed. We saw a lot of that and heard of a lot of it with universal life policies that were issued when interest rates were very high. People ran into issues with compounding loan balances. Let's look at some better examples. Let's look at taking a loan, loan interest accruing, but we pay the loan interest out of pocket. I like to see that stuff up front as well. A policy is going to perform just fine in this example. What's pretty interesting about this is that direct recognition example with the higher dividend rate on borrowed funds. Not much difference there. I pulled out $200,000. On the example with the loan outstanding, I've got 1250. Let's look at 50 years down the road. 2 million compared to the growth example, 1.972. How on earth does this one have more when I borrowed out $200,000? Initially, it's kind of like, wow. But then when we drag it back down to earth is, to be fair, we've been paying $12K in loan interest every single year since year 6 or year 7 in this example. So that's additional out of pocket technically. So I want to factor that in as well. I still net more money in this example considering that I've paid in a lot more or paid out of pocket $12K per year in loan interest. That's the kind of stuff we like to make transparent. And then we've got the repayment example, which matches the direct recognition chart you saw earlier. Always fun stuff to look at. 562, 591. So I know we covered a lot in these series of videos. I hope that you found it helpful. If you have any questions, reach out. If you're in the business and would like the real nitty-gritty and more training on how to construct policies like this and then how to communicate the ins and outs of the detailed illustrations, reach out. We have information. And if you're a consumer that wants more information or would like to look at policy options, feel free to reach out. We are here to help wherever we can. Enjoy, and we will talk to you in the future. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.